In this video, I want to show you a different type of way on how to enter on supply and demand zones. The topics that we are going to cover in this video is different types of inside bars, and then we are going to cover supply and demand zones. We are also going to cover the market structure so that we can at least understand how the market behaves. And lastly, we are going to do some few examples. So you might be wondering if this video is for you or not. This video is basically for new traders. You can also use it if you are a intermediate trader or a professional trader if you want a different trading entry into your trading style. So basically, an inside bar is a candlestick that is within a range of a previous candlestick. Like for example, you can see that this candlestick here, the low is right here, and then the high is right here. This is the high. Then this candlestick is within this candlestick range, like it's inside like this. So basically, it will be something like, let's say this is your bullish candlestick like this, then it closes around here. Then we have this bearish candlestick here, which is trading in this range here. It doesn't even break the previous high. It doesn't even break the previous low. So that means this area here is still within this previous candlestick's range. So we are going to use this as our trading guide to enter the market. So we can clearly see that after this inside bar here, you can clearly see that the market broke to the upside and eventually came down to this area. So that means this is our bearish rejection, even though we can clearly see that this candlestick is still bullish. But based on this week, it shows that the market was rejected to push to the upside. So this will be your confirmation for the market to move lower. But then you can also use this as your entry to enter by using a sell limit order here. But you have to check if this inside bar is still on a supply or demand zone. If price is not on the supply or demand zone, that means you basically have to avoid that setup. So let's move on to another example so that we can see different types of inside bars so that we can clearly understand them, so that we can use them in our trading style. This here is our inside bar breakout. We can clearly see that we have this bullish candlestick, also followed by this candlestick here. This is an indecision candlestick here. So basically here we can clearly see that we don't have a direction of the market. The market was pushing to the upside very aggressively, but then it decided to trade very slow. Like for an example purposes, it will look something like this. The market is pushing to the upside, and then from here, it just started to do something like this. So there's no direction here. The market tried to push to the upside very aggressively, but then it got rejected, and it started to push lower aggressively, but it rejected. That is why you see this candlestick forming here. So in this kind of situation here, if you are in a, let's say we are in a supply zone here, you see this pattern forming. Let's say we don't have this one here. That means right now you will wait for the market to break here. This is where you can put your sell limit, because sometimes price action is not clear, so we have to use some alternatives trading style to enter the market so that we don't miss out. So that means we are going to put a sell limit order for in case if this candlestick breaks to the downside, then we are in the trade, and then our stop loss will be around this area. So let's move on to another example so that we can at least identify different types of patterns. Here, this is the same one, a different kind of inside bar. You can clearly see that we have this high and then we have this low, but this candlestick here, it didn't break to the upside, it didn't break to the downside. So that means we have an inside bar. So the same thing will apply if we are in the supply zone here. We can still enter the market using a sell limit and then wait for the market to play out. This is basically very easy to understand. Just have to find those inside bar and properly use the risk management to enter the market. So from here, if you understand the concept of inside bar, we can move on to touch on supply zone. Supply zone basically is a strong move to the downside. This will be created by a single candlestick or a multiple candlesticks here. So the strong move to the downside, the impulsive move to the downside after a bullish momentum, this is what we call, this will create a supply zone. So basically it will be something like a move to the upside. This will be this candlestick, and then this sharp move to the downside will create a supply zone around this area. So every retracement around this area will be looking to enter the market short. So from here, that means we will be looking to enter the market short when price returns to this area. So when price returns to this area here, you'll be looking to enter the market short. It can be created by a single candlestick or a multiple candlesticks. And you can also reduce the risk by drawing the zone from here for the last candlestick, on the last candlesticks open, even on this area here. But in this way, you are going to miss a lot of trades because you are not using the whole area of this candlestick momentum. So let's look at the demand zone here. The same thing will apply. A sharp move to the upside after a bearish momentum. This will create a supply zone. So you'll be looking to enter the market long here, and even here you'll be looking to enter the market long here when price returns to this supply zone. And you can clearly see that here we have multiple candlesticks. As I said before, we can have one or more, so it all depends on price section. So let's look at the market structure patterns that you should focus on. Basically, these ones are very easy to understand because they are everywhere on the market weekly. We have the first one here. Here we have a break of market structure. Also, price manipulated this previous low to have this low here. Then price shoot to the upside, correct around this area, and you can clearly see that we have multiple lows here, which can be used as our area to target before we can enter the demand zone here. So from here, this is where you should be looking for that candlestick. If the market doesn't give you any form of confirmation, because sometimes we know the market can give us a different types of confirmation candlesticks. So this one is where you should focus on, because sometimes you can miss an entry because you don't have other alternative trading entries in your strategy. So this one here, it will be like this when the market is moving to the upside after breaking the previous high. This will be your higher high. This will be your newly formed higher high, and then the market correct in a zigzag correction. Then you will wait for the market to create or maybe spot that demand zone around this area. Then you'll be looking to enter long here if you have that inside bar. If you don't have that inside bar, then the pattern will be invalidated, or maybe you can use some other trading entries to enter the market right here. This one here, mostly this pattern is a reversal pattern here. It will look like the market is moving to the upside while this is a correction here. Then the market will shoot to the downside very aggressively, and then you will wait for the market on the demand zone here to make an entry. This is where you'll be looking to enter the market, and then you have to find that inside bar around this area. So let's look at the supply zones examples. Here we can clearly see that price was moving to the upside with a higher high, higher high, higher high, and then this is our higher low, higher lows here. So we have another higher low. Price broke this higher low here very aggressively. So that means right now we have a new lower low. This is where the market will create your supply zone here. Then you will wait for that pattern around this area. If it doesn't form, use other alternatives to enter the market, because we can clearly see that price broke the structure, and then you'll wait for the market to break this. The downside about this is that the stop loss will increase, and then the risk to reward will also be lower. So I do recommend it for those who are looking to avoid missing a trade, or for those who want to have more trading entries, or maybe those who want to grow their account very quickly. so that they don't miss out on waiting for a single entry strategy every time, because the market can take at least a week without even seeing an entry if you are using higher time frames like me. But obviously the market will have entries every day. It just depends on the market that you trade, because you already know that you might even miss a trade. So let's look at another example here. You can clearly see that price is just, this is a correction here. This is a correction. This move here, the whole move to the downside, this is your impulsive move. So from here, you have to wait for the starting point of that impulse for the market to come and retest, only if you see a supply zone. And you can also add some FVG here so that you can enter the market around this area using the inside bar pattern. I hope you understand very clearly, guys. So let's move on. Here, this is a typical example of how you should look at this structure. We have a break of market structure right here, and then you can clearly see that the market was pushing to the upside, but then the market shoot to the downside very aggressively. We will come to this one later on. This pattern here, mostly this is a reversal pattern. So then if you are looking at this, let's say maybe in the 4 hours time frame, you will be looking to enter the market right here if you see a supply zone, or maybe you can add some confluences that you are waiting for the market to fill up this FVG, fair value gap, or an imbalance in the market. Then you have to spot that candlestick around this area. Okay, I hope everything will be clear. So this area here is where you look for something like this, and then because you already know that you want to take a bullish trade, that means you'll wait for the market to break this inside bar momentum, and then you can enter the market. And sometimes you can wait for the market to break to the upside and then wait for any retracement to enter. It just depends on how are you willing to take that entry, because sometimes it's good to make an entry on retracement because you already have the confirmation that the market is likely to push to the upside. But if you don't have that confluence, then that means you can enter the market on the breakout. Let's look at this example here. Here, we don't have anything major. We can draw up our demand zone here. This will be your demand zone. If you are entering on this one here using a rejection candle, maybe your stop loss is around here, because we can see a break of market structure here, and then we have this high, and then we have this high here. So from here, we can clearly see that we have an inside bar here, this candlestick, because we can see the structure like this. We have this structure like this, okay? And then we want to enter around this area. Look at this price action. You can see that the inside bar was broken to the downside. Obviously, you won't even take a sell here, because you are looking for a long position only. The market manipulated this inside bar and then it shoot to the upside. When this breaks here, this is your confirmation that the market is likely to push to the upside. It's either you can put a buy limit order here and then wait for the market to break it, or you can wait for the market to break this inside bar area range and then wait for a retracement like this and then enter the market right here. It all depends, but doing this will likely give you less trading days because you are waiting for a retracement. If you know how to calculate your risk properly, every trade should not make you to panic. So from here, we can do something like this, or put a buy limit order here. This is also a confirmation because we have this demand zone from this candlestick. Okay, also price, let me show you from here. This is the range of the inside bar. We are going to do something like this. So basically what the market did here is something like this. It was just playing around, and then suddenly we have this move to the downside, and then price closed inside this range. So that means right now we can wait for the market to confirm. If you see that we have a bearish candlestick like this one, you can wait for at least this bullish candlestick to close so that it can give you a little bit of a confirmation that the market is likely to push higher. And then even after this confirmation here, you can still wait for the market to retrace down and then you can enter around this areas here. If you don't have confluence to enter after this candlestick based on different market conditions. So that is how you can at least try to understand this. I hope I am very clear on this one. If this is very difficult, guys, I'll try to explain it a little bit further with some few examples when we move forward. So let's see how the market behaved. You can clearly see that the market shoot to the upside, okay? But then, if you are waiting for this retracement from this area, you won't be even in this trade. But for those who are waiting for a retracement, they will be inside this trade, or maybe if you have entered using this candlestick close. It all depends on how you want to make that entry. And there are a lot of inside bars in the market. There are a lot of inside bars in the market. You can clearly see that even this one, it broke to the upside. And then we can see the market shooting to the upside. And also this is the 5 minutes on gold. This one here, if you have entered, obviously this candlestick here would have took you out. There are a lot of different examples. Even this one here, price broke with this candlestick. Obviously this was impulsive. So that means you took the entry from here, moving to the upside. I hope you understand the concept of inside bars. Let's move on to another example. Here we can see that we have a supply zone. We have an internal break of market structure, which is also a manipulation to enter the supply zone. So from here, what you can do is that you can wait for this rejection on the supply zone, or if you don't have confidence that the market might even make a double rejection here, then if you spot an inside bar like this one here, you can put your sell limit here. For in case if the market breaks this, then you are in the trade. So basically your stop loss will look something like this. Before this candlestick can appear, you can wait for the market to put your sell limit here, because you already see the structure. It's like this. This is your supply zone here. You're looking to enter the market right there. So for the market to shoot to the downside. And also don't forget to take profit, because I see a lot of people, they don't even take profits. Okay. I hope you understand this concept here. And then you can clearly see the market shooting to the downside and also aggressively reversing. This is also on gold on the 5 minutes. So now let's look at another example here. You can see if right now, let me show you the structure. We have the structure here. You can clearly see that we have this highs being broken. And then lastly, we can see a break of market structure. Market is making some lower low. We have some lower lows. And then we have a supply zone here. This is where you should look for that candlestick pattern. This is also on gold on the 15 minutes. So let's clear this up so that we can see everything. The market shoot to the upside very aggressively with this candlestick, made this bearish candlestick. But here we can see that we have an inside bar. Okay. So for now, you can put your sell limit here and then wait for the market to shoot to the downside. So your setup will look something like this. Then what you have to do is wait for the market to move to the upside, to the downside. And also for those who were waiting for that retracement, they can still wait for that retracement because they have a confirmation their stop loss is here. Then you can wait for the market to shoot to the downside. It's basically not that difficult. Even if we look at this area here, you can clearly see the pattern again. We have even the pattern will look something like this. Let me show you. We have a move to the upside. We have a low here, and then we have a high. This is a high. We have a high, and then we have this low. So from here, we can clearly see that the market manipulated this low here and then entered in the demand zone. So that means you are waiting for the market to give you the same scenario like this. And we can see that price made this strong move to the downside, touched the demand zone, and then made an inside bar on the next 15 minutes. So you can see that we have an inside bar here, followed by another inside bar with this candlestick here. So that means right now, you can put your buy limit order here, buy limit, and then price confirmed with this candlestick here. Okay, I hope you understand it very clearly. So from here, what am I saying throughout this video is that even if, let's say right now, you have a setup like this, you are waiting for the market to trigger around this area, but then you see prices around this area. This is where this entry strategy comes in. It can help you to not miss a lot of trades so that you can enter more trades in the market. I hope you understand it very clearly. Let's look at another example. We have USD CAD on the 15 minutes here. You can clearly see that we have low, manipulated this high, and then we have this, and then we have an inside bar here. So let's draw the zone. We have this demand zone and then followed by this inside bar. So from here, that means you are waiting for the market to break this inside bar so that you can enter the market. So let's put the entries here. We have this stop loss and then the entry price area. And then we can also see that price is at the demand zone. So we will be looking for the market to move to the upside. So let's look how the market behaved. And we can clearly see that after this breakout, the market just shoot aggressively, then started to make a huge correction here before we can see another upshift on the market. This is basically how you should at least understand it. And even from this area here, we can still see another inside bar, which can be in this supply zone. You can still take this few sell in the 15 minutes and then hold for more if you have the patience. I hope this video was very helpful, guys. But then if you want more videos like this one, please comment below and suggest me a video so that I can try to be at least consistent, because I'm not. I was having a fever, that is why I was not able to upload in the past few days. I'll try to be on track. So guys, please consider subscribing to the channel, like the video, share this video with your friends and family, and then one prayer is equals to one subscriber. See you on the next one.